Okay, welcome back. I don't know if you can see this, but that's me. And let's put OneNote on the screen here. Okay, so let me just pull up this video. Can you guys hear me? Again, please let me know if you're able to hear this conversation. I see there are 9 of you watching, so just quickly checking the chat here. Perfect. Hopefully this sounds okay. It is on my laptop as opposed to the PC. Okay, we'll walk through one question and then we'll see how things are going. The following are some transactions of Surrendell Company for 2014. They use straight line depreciation. They've got a December 31st year end. The first transaction is on January 2nd. We scrapped a piece of equipment that originally cost $8,000. It was fully depreciated. For each of these disposals, prepare a journal entry to record the depreciation from January 1st to the date of disposal if required. And then for each of these disposals, indicate if the company has increased or decreased cash, equipment, accumulated depreciation, total PP&E, and profit, and by how much. Okay, well, let's do this. We're scrapping a piece of equipment on January 2nd for $8,000. We can see that it's fully depreciated. Okay, so take 30 seconds, see if you can try to do that journal entry. So on January 2nd, we scrapped a piece of equipment. It originally cost $8,000. It was fully depreciated. So here, we're going to debit the accumulated depreciation for $8,000. We're going to credit the equipment for $8,000. We're getting rid of a piece of equipment that was already fully depreciated. On April 1st, it says we retired a piece of equipment that was purchased on January 1st, 2005 for $45,000. It had an expected useful life of 10 years with no residual value. Okay, so for this one here, we are going to need to update the depreciation because we're selling this on April 1st, or we're retiring it on April 1st. With that first one, because it was on January 2nd, there was no depreciation up to the date of disposal. But here, we do need to record that depreciation for January, February, and March, but not April, because this is on April 1st. So the way we're going to do that is on April 1st, the first step we're going to do is to record the depreciation up to the date of disposal. Our cost that was given to us in the question was $45,000. We're going to divide that by the 10-year useful life and multiply that by 3 months, right? So 3 over 12. And this gives us 1,125. So here we're going to debit depreciation expense. And we're going to credit the accumulated depreciation for 1125. What this does is it now updates our accumulated depreciation so that we're now fully reflecting the cost of this asset. Or sorry, the total accumulated depreciation on this asset. The second thing we're going to do is get rid of that piece of equipment. So what do we have in the accumulated depreciation account? Well, if we look, we would have been depreciating this piece of equipment for how many years so far? We purchased it on January 1st, 2005, and we're now into 2014. So how much do we have in accumulated depreciation up until now? Well, it was 2005, 6, 7, 8, 9, 10, 11, 12, 13, and then we're selling this in 2014, so 9 years and 3 months. Well, what was our depreciation expense per year? It's 4,500 per year times 9 years, which gives us 40,500. We just added 1,125. So that means in this account, we've got $41,625,000 in accumulated depreciation. And now let's take this off of our books. On April 1st, to get rid of this asset now, we're going to debit the accumulated depreciation. For 41,625. We're going to debit a loss on disposal. That's 3,375. And we're going to credit the equipment account for 45,000. Okay, I'm just checking in on the chat to see how things are going. Any questions up to here? Again, there's two parts to this. The first part is to update the depreciation. The second part is to record the actual disposal or sale. Okay, so one person says all good so far. I'm hoping that goes for the other 16 of you who are on the chat. Let's try the next one. On July 30th, so this is now halfway through the year, we sold equipment for $1,100 in cash. The equipment was purchased on January 3rd, 2012 for $12,600. It was depreciated over an expected useful life of 3 years with no residual value. Okay, so step one, we're going to record the depreciation up to the date of sale, just like before. So on July 30th, well, 12,600 divided by 3 years times, how many months is that? January, February, March, April, May, June, July. We're on July 30th, so we're including July times 7 over 12. And that gives us 2,450 debit depreciation expense. $2,450. Credit accumulated depreciation. 2,450. And now also on July 30th, we're going to get rid of this asset. And it says we sold it for $1,100 in cash, right? I think. On July 30th, we sold equipment for $1,100 in cash. It was purchased on January 3rd. It was depreciated over an expected useful life of 3 years with no residual value. Okay, so let's try to figure out the accumulated depreciation. Again, I'll give you guys a couple of minutes to do that. In the first year, we would have $4,200, $4,200 again, and then in this year, 7 months, so $2,450. Well, that's $10,850. So our journal entry on July 30th to get rid of this piece of equipment is debit cash, $1,100, debit accumulated depreciation, for $10,850. We're going to credit the equipment for $12,600. And it looks like we're missing some debits here, so we're also going to debit loss on disposal. And that's $650. Okay, so that's how we deal with the sale of a piece of property, plant, and equipment. Finally, we're going to try one more here. This one's fairly challenging, so we're going to walk through this slowly. On November 1st, we traded in an old vehicle for a new vehicle. We received a $10,000 trade-in allowance and paid $36,000 in cash. The old vehicle had been purchased on November 1st 2007 at a cost of $35,000. The useful life was 8 years. Residual value was $5,000. Fair value of the old vehicle was $7,000. And that was on November 1st, 2014. Okay, so there's quite a bit of information being thrown at us here. We traded in an old vehicle for a new one. We got a trade-in allowance, and we paid $36K in cash. The old vehicle was bought for $35,000. Useful life was 8 years. Residual value was 5. The fair value of the old vehicle was 7. Now, they don't tell us the fair value of the new vehicle. So I think what we're going to need to figure out in this question is not only how much is our accumulated depreciation, but how much are we giving up in exchange for this new vehicle? We need to know how much we're giving up so we can then measure fairly the actual trade. All right, so first things first, let's think about what we're going to do here on November 30th, or November 1st. $35,000 was our cost, minus the $5,000 salvage value, divided by 8 years, times, and how many months are we talking about here? January, February, March, April, May, June, July, August, September, October. Do we include November? And the answer is no, because we're November 1st. So 10 over 12, and this gives you $3,125. That's your depreciation up to November 1st. Okay, so let's record that. Debit depreciation expense. Credit accumulated depreciation. $3,125. The second thing we're going to have to record then is the actual trade. So on November 1st, we're going to debit the vehicle account, the new vehicle account. Oops. Vehicle for $43,000. I'll explain why in just a second here. We need to debit the accumulated depreciation. And I want you to try to work out how much that is. I'll give you guys about 30 seconds to try to work that out. Sorry about the noise in the background here, the joys of working from home. Okay, so the accumulated depreciation here, if we take a look, you might have realized we're going from November to November, right? So we've owned this piece of equipment or this truck for 9 years. So how much do we have in the account? I'm looking at the chat to see if anyone's got an answer here. The old vehicle was purchased for $35,000. That was back in 2007. It is now November 1st, 2014, so not 9 years, my apologies, 7 years later. Are we past 8 years? Let's just take a look here. We bought it November 1st, 2007. It's now November 1st, 2014. So where are we at? 35,000 minus the residual value, which we estimated to be 5,000, divided by the useful life, which was 8 years. How much is that per year? $30,000 divided by 8 is 3,750 per year, times 7 years, and we're at 26,250. So in our accumulated depreciation, we should have 26,250. Scott, you're close. Because we're going November to November, in that first year when we bought the asset, we would have only depreciated 1 month. So I think that's what might be throwing off your calculation. In that first year, we bought it on November 1st. So in that first year, we would have only depreciated 2/12ths for November and December. This year, we're at 10/12ths. So in total, we're actually at 26,250. I'm going to walk through that one more time just to make sure that that's completely clear. Our depreciation expense per year is $3,750. In 2007, so again, going back here to 2007, we bought the asset on November 1st. So between November 1st and December 31st, 2 months go by. Then we've got 6 full years. And then this year we've got January through November. So 10 more months. So in total, we're talking about 7 full years. Okay, so that allows us to get back to this transaction here, where we're looking at the trade-in. I'm going to get rid of this new cost because we're going to do that in just a second here. If we look at the question itself, it says, let's get rid of this thing. So we're going to get rid of the accumulated depreciation on the old vehicle, 26,250. Okay, what else do we know? Well, we know we're going to credit the old vehicle account, and that was for $35,000. The amount of cash we paid was $36,000, and that was given to us in the question. Now we got to figure out how we measure this new vehicle. And how much was the new vehicle? Well, if we look at the question, it says traded in an old vehicle for a new vehicle. The trade-in allowance in this case doesn't really affect anything because they haven't given us the fair value or even the selling price of the new vehicle. They haven't told us anything about it. All they told us is that what we gave up was $7,000 worth of an old vehicle. So the old vehicle was worth $7,000, and we gave up cash of $36,000. So what we gave up was $43,000 in fair value. And that's what we use to measure the new vehicle. So here we're going to debit this for $43,000. We debit our accumulated depreciation for $26,250. We credit the old vehicle for $35,000. We credit cash for $36,000. And if we look, our debits don't equal our credits here. And what we're missing is a loss on trade-in or a loss on disposal. And the difference between our debits and credits is $1,750. Okay, and that is our loss on disposal. That's about as complicated as it gets for a trade-in, so I'm hoping that that's okay. I'm kind of keeping an eye on the chat here to see if there's any other questions. Okay, let's take a look at problem 9-1A. Again, this is in the questions that are posted online. In 2014, Cadillac Company had the following transactions related to the purchase of property. All transactions were for cash unless otherwise stated. On January 12th, we purchased real estate for a future plant site for $420,000. We paid $95,000 in cash. We signed a note payable for the balance. On the site, there was an old building, and the fair values of the land and building were $400,000 and $40,000 respectively. The old building will be demolished and a new one built. Okay, so how do we deal with all of that information here? Well, we've got a debit. Let's see here. What is a future plant site? Where do we debit? We're going to debit land for $420,000. We're going to credit cash for $95,000. And we signed a note payable for the balance. And that's going to be $325,000. Now, all the other information they're giving you there is kind of useless because here on the site there was an old building and the fair values of the land and building were $440,000. We don't care. We paid $420,000. The old building has no future benefit because we're demolishing it. Had they told us we could sell the old building and make some money on it, then we could have certainly counted that for something. But in this case here, they haven't. All they've said is we're demolishing and getting rid of the old building, so we're getting rid of it. Okay? On the 16th, we paid $8,500 for legal fees on the real estate purchase. So on the 16th, we're going to debit land and credit cash. Notice here, I'm not debiting any legal expenses or anything like that. Because the legal fees were required to buy the land, it's part of the cost of the land. So be careful with that. On the 31st, we paid $25,000 to demolish the old building to make room for the new plant. Well, guess what? On the 31st, we also debit land and credit cash. Okay, on February the 13th, what happens? We received $10,000 for residual materials from the demolished building. So here, we received some cash. It looks like we were able to sell off some of these old materials. What that does effectively is it reduces the amount it cost us to buy the land. So here, we're going to debit cash for $10,000. We're going to credit land for the $10,000. That piece of land cost us $10,000 less. On the 28th, what happened? Graded, so we leveled out, and filled in the land in preparation for the construction for $9,000. So again, preparing the land to get it ready for use is part of the cost of the land. We're going to debit land for $9,000. We're going to credit cash for $9,000. Again, this question goes a really long way to make a very simple point, namely, there's a lot of costs we can incur that are part of the cost of the land. On March the 14th, we paid $38,000 in architect fees for the building plans. So here we're paying an architect. This isn't salary expense. We are actually going to include that cost as part of the cost of the building. On March 14th, we're going to debit building. And that's $38,000. And credit cash for $38,000. March 31st, we paid the local municipality $15,000 for permits. Where are we here? March 31st. We're paying $15,000 for permits. Debit building. Credit cash. Again, those permits are necessary to build the building. On April 22nd, excavation costs for the new building were $17,000. Okay, I'll save us the trouble. Those excavation costs, we're going to debit building, credit cash. Again, $17,000. On September 26th, the construction of the building was completed. The full cost was $750,000. We paid $150,000 in cash and signed a mortgage note payable for the balance. So just writing down the other one there, that was 17 and 17. And then on September 26th, debit the building, $750. Credit cash, $150. Credit the note payable for the balance. On September 30th, we purchased a one-year insurance policy for the building for $4,500. Okay, don't be fooled by this one. On September 30th, we're going to debit prepaid insurance. A lot of students in this question here will debit building here just because we get so conditioned to do that over and over again. But this is insurance that is relating to the building but not necessary to get the building ready. Debit prepaid insurance, credit cash. $4,500. Paved the parking lots, driveways, and sidewalks for $45,000. This is October 20th. Debit land improvements. credit cash. And then finally, installed a fence for $12,000. So on November 15th, where's this fence going to go? Debit land improvements, credit cash. All right. Next class, we're going to work through the rest of these problems. We're also going to go through some looking at units of production as well as double declining balance. I do apologize for the snow day today, but I'm hoping that this was actually reasonable. And I will see you guys in class on Wednesday. If you have any questions at all, please shoot me an email. But otherwise, I will see you guys next class.